Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. The aim of these case study episodes is to share with you the application of those principles works out in real life. Before I get started, just another really quick reminder, 97-point financial health checklist. Link is in the show notes. Over 500 people have downloaded it, so hopefully it's helping plenty of people. And if it's something you're interested in, go check that out. Okay, let's get into today's episode. And it's about some clients that I've only worked with for almost 6 years. It's not just a little bit shy of 6 years. Started working together in late 2018. So a relatively short period of time. But, in a lot of these case study episodes, I've shared, a really common theme, interestingly, for, clients that I've been working with for a lot longer is that the property hasn't worked as well and the shares and super have worked quite well. Well, I thought it's time to share a case study episode where actually property's done most of the heavy lifting, albeit over a relatively short period of time. And I guess my observation is that, we did invest, or clients did invest in a lot of apartments, say 10 to 15 years ago, during that sort of 5-year period of 10 to 15 years ago. And we probably weren't as active in the wealth space at that particular time. We didn't have a lot of ongoing clients. And also I wasn't as prolific in terms of my analysis and thinking around investing back then either. I think if you go back 15 years ago, I was only writing a blog every month rather than 12 times a year, maybe 11 times a year rather than every week. And so I think we're better today in terms of our analysis and approach towards investing than we were 15 years ago. But hopefully we will be better yet again in 15 years' time from here. I think that's the whole idea, is you practice your craft, you get better and better at it. And so I think the clients that are working with us today are going to benefit from that experience, not only as me as the individual, but us as a team and working together as a team. We'll get better and better at it. And I mentioned it as a bit of a side note to this case study episode because I don't think it's exclusive to us. I think that's true in lots of different aspects in life, both in our profession and our personal lives, that of course, as we get older and we have more experience, we get better and better at what we're doing and more robust, I guess, in terms of decision making. Anyway, let's go on with the case study episode. And this one, as I said, we've increased investment assets almost sixfold over the last 6 years. Pretty good outcome, mainly due to property. So as I said, we began working together in late 2018. Clients at that time were mid to late 30s, higher income earners, professionals, so forth. Their net worth at that particular time was $2.9 million. So, really off to a pretty healthy start, partly thanks to some help from parents. They only had a couple of assets when we started working. They just upgraded their home. So the home was worth 2.9 and they had about 320,000 of net debt against that. So almost about 2.6 million of equity in that home. As you can see, that's thanks to help from parents in terms of, they're good savers and hard workers and all those sorts of things. So it's not just thanks to the parents, but that's why, naturally you'd be thinking, gee, they've got a lot of equity in their home. So anyway, and then they had some super, 110 plus 180, almost about 300,000 of combined super between the two spouses. And we started working together. And quite often that's the impetus, right? People's aim typically is let's buy the forever home. And then once that's bedded down, they tend to then turn their mind to thinking, okay, well, what about building wealth? But also in this client situation, they had a pretty significant uptick in income as well. So the question is, what do we do with that income? And the home that they bought, they knew they were going to complete some pretty substantial renovations to it. So they knew they wanted to do that, but then what else? And they also knew that if they did the renovations, it's going to give rise to a lot of debt. And again, thinking, okay, how are we going to repay this debt, but also build wealth? So where are they today? So I said about 2.9 million of net worth back then. Today, it's about $5.1 million. So 170% increase in about 6 years. But a lot of the heavy lifting has been done by investment assets. As I said, they had about 300 300,000 of super when we started working together. They've now got about 1.7 million of investment assets. So it's made a large contribution in a very short period of time. So they've got the family home that's worth about $6.5 million. And then they've got about $3 million of debt against that, thanks to a really substantial renovation. But again, it's their forever home. And in the long run, they've got enough cash flow to deal with that debt. We have projected that they, as well as doing everything we want to do in terms of regular investing, we're aiming that they'll repay that over the next 10-ish years. Okay. We bought a property in Queensland at the end of 2018 for about 980,000. That's worth about 1.8 now. So, net of, debt, because we obviously borrowed the costs and so forth, we've got about $700,000 of equity in about 5.5 years. So that worked out really well. The client was really keen to go buy an apartment in Melbourne just off the back of all the stuff that I write about, investment grade apartments. So in early 22, a couple of years ago, they bought a 3-bedroom apartment in a really good block in Elwood in Melbourne for about 900,000. That's probably worth about, looking at comparable sales, worth about 950 now. So there's a little bit of growth, but no real equity in that asset. That's just really covered its costs. But I think that will be a really good asset bought at a really good time in the cycle. We've been investing in a corporate beneficiary in the share market. We're about 300,000 in there, with plans to invest a lot more into that asset or into that entity. And super's grown to about 725,000. So obviously well invested over the last 6 years, plus concessional contributions. We've helped with a variety of other matters as well over the last 6 years. Of course, they wanted comfort that if they did those major renovations, that they'd still be able to build wealth and repay the debt. So a lot of sort of strategic planning, building a financial model to model that out, of course, just to make sure that's going to work. Of course, we looked after their insurances, making sure they're protecting risk, estate planning, taxation planning, all those sorts of things, all the sorts of things that go along with it. So they're off to a pretty good start. Now, as you know, I like to, in these case study episodes, reflect and go, well, what can we learn? What have they done well? What could have we done better? Those sorts of things. And hopefully then you as the listener, can apply some of those learnings in your own situation. Because I think learning from other people's experiences is really valuable. So I guess the first one is market timing. And again, just related to the preamble that I had at the beginning of this episode, reflecting back, our approach towards investing 15 years ago really wasn't, I don't think, was sympathetic to the cycles, the market cycles and the distinct market cycles that, that I've analysed over the last sort of 15 years. So a lot of these investments that we've made 15 years ago, and we weren't involved in a lot of them, by the way, because we weren't offering wealth advice at that particular time. But if I had my time again, I would have written an article back then. Knowing what I know today, it's all great in hindsight. Now those assets will work. It'll just take a lot longer for them to work to see the returns, but obviously market timing, they hit it perfectly. I've written before that I hosted a investment seminar in my office in November 18, where I sort of talked about why I thought Brisbane was the best valued market at that particular time. And obviously that reflected in the advice that I gave these clients in terms of purchasing. And similarly, I did a similar blog episode in mid last year about Perth. Obviously that's kicked off. And you might recall in May, I wrote one about Melbourne. The growth over the next 10 years in Melbourne, I think, is going to be really strong too. And dollar value wise, I think it'll be the strongest. I don't think we're going to see any growth in the next 1 to 2 years, but I think it's looking more and more like there'll be a change in government in Victoria. That'll be the impetus to change sentiment in regards to property in Melbourne. Anyway, timing was perfect for them. They got into that Brisbane market, and they've not only got an asset that's really well located, it's a great quality asset, so it's going to provide strong growth over the next 30 years, which is the most important aspect, by the way. But it's just nice that it has that kick of growth in the early period of time. The thing that they did well, without necessarily our advice, by the way, because it was before we started advising them formally, but they bought their first home, their forever home, if you like, as soon as they possibly could. They bought something that they knew that they'd had to renovate, but they got into that pocket where they wanted to be. They bought mostly land. I mean, the building was good, but it was old. The structure was fine, but, it needed a lot of renovating to build something that they really want and love and will enjoy over the next few decades. Now, if they didn't do that, they'd be looking at a lot more borrowings today because obviously land values changed. And so that's something I always talk about. I've done a few episodes about it, but getting into that forever home as soon as possible and working out how to do that is really critical and has positive compounding impacts from a financial planning perspective. And at the same time, they've been investing in the share market through both super and through the corporate beneficiary. So they've got a two-pronged approach where they're going, okay, we're investing in property, and they've made a couple of acquisitions over the last 6 years, but at the same time investing in the share market. So they're hedging their bets a little bit. Both have worked out really well. Elwood hasn't provided a lot of growth yet. It's only been held for a very short period of time. But in 10 years from now, they'll be in a fantastic position just because of the work that they've done over the last 6 years. And I think it's a good example of how, trying to not necessarily put all your eggs in one basket, trying to invest in property and shares over a long period of time will serve you really well. Now, I wouldn't do it at the cost of compromising on quality. So, if you only have the capacity to invest in property and you don't have any capacity left over to invest in shares, so be it. But for those that do have capacity to be able to do both, sometimes the mentality is, well, I'm just going to focus on property and I'm going to gear to my eyeballs and I'm just going to go hard on property. But the reality is, and that's good, but gearing doesn't always work and it's not going to work uniformly either. And there is some merit, I think, a lot of merit in sort of splitting some of those resources out into the share market, again, whether that's via super or outside of super. And if you're young, it's probably outside of super to give you that flexibility. So I wanted to share that case study because, I think the case studies that I've shared to date have been a bit dingy in terms of property performance, but also it sort of illustrates, how if you get that timing right, it's not all about timing. It's first and foremost about the quality of the underlying asset. But if you give consideration to that and you're investing well with discipline, that even in a relatively short period of time, and returns are random, so it's partly luck, but in a relatively short period of time, you can make some substantial inroads in terms of building wealth. Okay, let's get into some listener questions. And this one's from Adam. Really good, thought-provoking question. So Adam's question is, my question relates to someone that at 60 years old with over $2 million inside super. Assuming that you want to work full-time until 65 and they meet the condition of release, so that is stop working, is it financially better to keep the super in accumulation, which is taxed at 15%, or move the 1.9 into pension phase, even though you have to take out 4% of the balance each year because that's the compulsory minimum pension amount? Have you ever ran the numbers on what's better? So just to let people give some context around this question, because it is a really good one. So at 60, you can access super and convert it into pension phase, as Adam's suggesting, up to 1.9 million of your balance. It means then if you do that, the investment earnings attract no tax, but you have to take out at least 4% of that balance each year. So therefore you are draining your super, potentially in a situation where you don't really need it. At age 65, you can access super even if you are still working. So at 60, you've got to stop working. You've got to be permanently retired from the workforce, but you could stop working today, convert your super into pension, and then start working next week. So there's nothing to stop you doing that. So you can really manipulate it when you're less than between 60 and 65 in order to get access to super. So Adam's question's really asking is, what is the tax savings from converting 1.9 million of your super into being tax-free versus the downside is, well, I don't really need to access super. I'd rather let it compound, and therefore I'm going to have to take out 4% of the balance for $80,000 a year. Compulsory, I've got to withdraw that. So there's a couple of things that you want to think about to answer this question. The first one is, what superannuation arrangements do you have? And I need to do another episode on this, but if you have a self-managed super fund or a wrap product or something similar like that, where the trustee is not going to change if you convert it into pension phase, then potentially what you can do is all the unrealized gains disappear anyway when you convert it into pension phase. So you're not going to pay necessarily if you're in that wrap product or a self-managed super fund, even if you didn't convert your super into pension at 60 and you kept working, and then your fund generate all these capital gains, as long as you didn't sell those investments, you're not going to pay any tax anyway, because when you convert it at 65 into pension phase, those unrealized capital gains just disappear. So it's really only the income that the fund earns between age 60 and 65 that will be taxed at 15%, and that's your tax liability. So that's what you could potentially save if you did convert it to pension. So you'd need to think about that in terms of, what are the makeup of your investments? What income do you expect the fund to produce? And then multiply that income by 15%, and that's kind of your tax saving. So if it's invested in a way that minimizes the amount of realized capital gains or income that you can earn between 60 and 65, the tax saving might not be as substantial as you might think. The other advantage of delaying converting your super into pension is that what's called the transfer balance cap is indexed. So the transfer balance cap is really the $1.9 million is the amount that any individual can have inside super that's tax-free if it's in a pension phase. And it's projected to change on 1 July 2025, so next year. That cap is indexed. It's projected to be indexed from $1.9 to $2 million at that particular time. So if you start a pension today, you crystallize your lifetime transfer balance cap, which will be 1.9. If you don't do it this year, but you do it after 1 July 2025 and it is indexed, I'm only projecting it will be, then your transfer balance cap is $2 million. You can have an extra $100,000 in an environment that's going to be tax-free. So that's something else to think about. And then the other concern or consideration would be, okay, if you're forced to take out the $80,000 a year, the 4% of $1.9 million, which is what you would be if you're in pension phase, what are you going to do with that $80,000? Now, what Adam's saying is it's surplus to his requirements. He's going to continue working, so he doesn't really need it. Now, if you could take that $80,000 and say make a non-concessional contribution into your spouse's super account, then all you're really doing is moving money from one super account into the next super account. You're actually not worse off by having to withdraw it. If you've already got a lot of personal investment assets and you take out another $80,000 and you go and invest that money, it's probably going to attract a lot of tax. So it doesn't really make sense then to convert into pension phase because you're going to be penalised. So there's a lot of moving parts here, people, and that's why super is so kind of confusing. But it also shows that, doing some planning and perhaps even getting some advice around this. I know I've got a vested interest in saying this, but there's a lot of moving parts here and it's important that you make a wise decision. So great question, Adam. I didn't really answer it because I don't know your personal circumstances, and of course I can't give personal advice on this podcast, but they're some of the considerations that I'd be thinking about. There could be other factors, of course, that are specific to your situation, but they're the main factors that I'd be thinking about. I think if your spouse had a low super balance, it might be a way of starting a pension today, might be a way of kind of evening up that balance, but I probably wouldn't start it until 1 July 25. May as well get the $2 million cap, get an extra $100,000 by waiting, what is it, another 6 to 8 months. Anyway, I hope that answers your question to at least some degree. Next question is from Michael. Hi, Stuart. I just listened to episode 315 on the best super funds. You were constantly referring to industry funds. What's the difference between an industry and retail funds, and why are retail funds not included in these discussions? It's a really great question, Michael. Awesome question. And look, just as a footnote, I do produce a episode every year around end of July, early August, depending on the release of results and the results from the research house that we use on reviewing super fund performance. So the question, Michael, to answer your question, industry super has typically or historically been a more cost-effective way of investing super. Whereas if you go back 10 years ago, for instance, financial advisors got paid commissions, in order to recommend products. And so you would have the likes of Vanguard and MLC and CBA that all have these super products that advisors would recommend, and they would recommend them and they'd get paid a commission. And as a result, the fees were quite high in these products and the investment returns weren't great either. So 10 years ago, you would go, I'm not going anywhere near a retail super fund because it's too expensive and the fees aren't great. The returns aren't great. So industry super is a bit of a no-brainer. Now, just after the Royal Commission, they banned commissions to financial advisors. And a year or so later, they backdated that. So you couldn't even get commissions from products you previously sold. It's a great outcome, by the way. It's probably one of the best decisions the government, and probably the only good decision the government's made with respect to the financial planning industry. It's changed over the last couple of years. And Michael, your question has really highlighted that, and something that I need to reflect in this analysis that I do next year, that retail funds are now becoming a lot more competitive and more transparent. And probably retail retail funds, the two differences, industry super funds are not for profit, but I would also say they're not for productivity either. It's good to be not for profit, but if you're not particularly efficient, that doesn't necessarily mean that the end user is going to save. And I've been quite critical of industry super and that hasn't achieved the scale, which is almost criminal. Retail funds are obviously generated by businesses or marketed and produced by businesses that are for-profit businesses. And so you would expect then a not-for-profit is going to be cheaper than an entity that's going for profit. But of course, the productivity and efficiency could be the gap there. And so there's more and more providers coming into this space to create competition with the industry funds, much needed competition with the industry funds. And perhaps the most well-named brand name there is Vanguard. So Vanguard has its own superannuation product and it's starting to gain traction. It's about 2 years old, give or take. And we've just been on the sidelines just watching it and seeing how it's performing and how they're going to implement it and those sorts of things. And we caught up with Vanguard just the other week to talk about it. So next year when I do the analysis, I think I'll include Vanguard as be industry funds versus Vanguard, if you like, because they are very competitive in terms of fees. And Vanguard is a not-for-profit business. It's a mutual entity. So it has a strong trend of reducing fees as it achieves scale, but a product needs to stand on its own 2 feet as well. So there's no appetite to have a loss leader in the portfolio. But Vanguard has actually reduced fees even over the last 2 years on its super product, a tiny reduction. But I think it's just sending a message to the market that it's doing that. BetaShares also bought a super business, an existing super business. So I'm sure BetaShares is going to get into the race as well and allow people to invest their super through ETFs. And so both those providers, I think, will provide much needed competition with industry super funds that are going to provide that sort of transparency and also maybe the flexibility that a wrap style product brings as well. So great question, Michael. The answer is historically, I mean, compared retail super funds because they've just not been even near competitive in terms of industry super funds, but it is changing. I acknowledge that. And from here on in, I will be including the retail funds that I think are, very competitive, I don't know what BetaShares is going to look like, but certainly Vanguard will be included in that mix. Okay, I got another question, or the next question I should say, actually is another question from Kyle because he'd referenced that he asked a previous question. And I've got to say, guys, these questions are really good. They're thought-provoking, so keep them coming. The email address is questions@investopoly.com.au. Anyway, Kyle asks, my question is, what would you normally say to someone approaching retirement in the next 5 to 10 years who doesn't have enough assets or super balance to fund the next 20 years of retirement? What investment strategy would you employ for the remaining 5 to 10 years of their life for someone with limited to no assets or not enough inside super? And it's a really good question, Kyle. And the reason I think it's a really good question is because there's really two opposing considerations or factors that someone in that position needs to think about. On one hand, they've got a very short time horizon. They want to retire in 5 to 10 years. So they really don't have a large appetite for risk or volatility. You don't want to embark on a particular investment and it doesn't give any returns over the next 5 years just because of the randomness of returns, and they're not going to be any better off as a result of that. So that's on one hand. On the other hand, if they don't take risk, they won't achieve their goal, right? So someone with a very low asset base has to take higher risk, such as gearing, for example, because if they don't do that, they won't achieve their goal and they have to make some lifestyle compromises. And that's why it's such an interesting question, I should say, Kyle, because you got these two competing priorities or considerations, and both are correct. Both have merit. So my answer is I'm not really sure what I would do or how I would approach it. It's going to depend on the individual and their circumstances and so forth. But there's probably 4 areas that I would explore talking to that person to try and uncover what that strategy might look like. The first one is, what compromises are we prepared to make? So what does retirement look like? And how much can we reduce the cost of retirement? How much are we willing to reduce the cost of retirement, therefore making compromises in terms of lifestyle? Now, I acknowledge the whole point of planning is to try and achieve your goals. So it wouldn't be the case of, what's the least amount of money that you need? But what I'd like to explore, what I would normally explore with that person is, do we have a realistic expectation of how much money we'll need in retirement? So someone with a very low asset base that wants to get to $200,000 of living expenses in the next 5 to 10 years, of course, that's unrealistic. So firstly, working out what that looks like. I would explore working longer, so increasing or extending the investment horizon a little bit. bit. 5 to 10 years, 10 years might be okay. 5 years is very short, makes it very difficult to make long-term decisions when you've got a key retirement date in 5 years' time. But 10 years is only just long enough. 15 years would be ideal, 15 plus. So I would talk to them about potentially doing that. And it could be, for example, work full-time for the next 10 years and then maybe part-time for the following 5 years. Again, it might delay then needing to draw too much capital and income from the investment asset base to try and make that work. So I'm trying to really understand, again, what compromises can we extend this time horizon, because that's the biggest challenge. Is if you give me 5 years to put a strategy together, it's going to be very dependent on the distribution of returns over that time. If I invest in a market that just doesn't give me much in the way of returns over the next 5 years, it could be fundamentally sound in terms of investment, but it's not going to help. I would then, if I could extend the time horizon beyond 10 years, I'd then explore how much risk can we take. So I think that's really talking about gearing. If we don't have enough to buy a good quality property, then maybe I can gear into the share market, either through external gearing or using internally geared products, which I've talked about in this podcast before. And it's not in my wheelhouse. I don't have very much experience with it, but I would also then understand how I could maximize social security benefits, so the age pension. And so that could be a couple of different things. There's what's called innovative retirement income streams, where they're a little bit like annuities, but from an asset test perspective, an income test perspective, only a certain percentage of them are included when determining social security benefits. So it's a way of holding assets outside of super, or even actually inside super too, that maximizes the age pension income. And then maybe also, over the next 5 to 10 years, 10 to 15 even, maybe using our home as a vehicle for building wealth could be the way to go, because obviously that would help, still maximize social security benefits, minimize capital gains tax, and then maybe using some sort of downsizer strategy to pull out equity in the home, maybe then put that in those innovative retirement income stream products that are then going to help maximize the age pension. But, the social security considerations around a strategy like this are going to be fundamental. That's not my business's key skill, but there's some advisors out there, plenty of advisors out there that have the skills in order to come up with a strategy like that. So I don't know what the answer is, Kyle, but they're the things that I'd be thinking about anyway. Doesn't really answer your question, so sorry about that. Okay, I'm conscious of time. I'll leave it there, and until tomorrow, bye from now.